Everybody loves a good quote, right? Well, in the world of investing, there's a lot of quotes from a lot of different investors, and so today, I thought I should look at 9 specific ones from some of the best investors to ever grace this earth and see what lessons we can learn from their words, which we can potentially apply in our quest to become the best investors that we can be. Stick around till the end, I have a bonus or two for you. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Number 1. The stock market is filled with individuals who know the price of everything but the value of nothing. This quote is attributed to Philip Fisher, who was a renowned American investor and author. He wrote a book titled Common Stocks and Uncommon Profits. This book outlined Fisher's approach to evaluating stocks and selecting investments based on in-depth research and analysis. Fisher is widely regarded as one of the pioneers of growth investing, and his book remains influential among investors to this day. From the quote, we learn that the price of a stock is not the only thing that we should be looking at in order to determine if a certain stock is a good buy or not. The emphasis is on the importance of understanding the intrinsic or underlying value of the investment rather than solely focusing on its market price. Fisher suggests that investors should consider the underlying value and potential of a company or asset before making investment decisions. By conducting thorough research and analysis, investors can uncover opportunities that may be undervalued by the market, leading to better investment opportunities. One of the things I've come to learn is that price is relative. So when we see the price of a stock, it is a good idea to look at other metrics in the company and compare them to the price. Then you can determine if the stock is overpriced, underpriced, or trading at fair value. As Warren Buffett once said, price is what you pay, value is what you get. There are times when a stock may be a little overpriced, but if the returns on that would make up for the price, they would make perfect sense to buy. And speaking of Warren Buffett, number 2. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is a famous quote from Warren Buffett, the Oracle of Omaha and arguably the best investor on earth. Buffett here emphasizes the importance of capital preservation in investing. He implies that protecting your capital should be top priority. By avoiding significant losses, investors can maintain their wealth and avoid major setbacks that may require substantial time and effort to recover from. This mindset encourages investors to focus on risk management and making prudent investment choices. This to me speaks to avoiding speculative stocks and going after whatever is popular at the time. You must be disciplined enough to not try and catch every fish you see, so to speak, because by so doing, you might end up not catching any at all. Instead, focus on catching the best one and your chances of success will be higher. Avoid unnecessary risk. Instead of listening to anyone and everyone and making a bet on the hottest stock at the time, take time to do your research so you know what you're buying and why. Another way that people can lose money is by not knowing when to cut their losses. If you hold on to a common stock for a long time, with no solid reason why, just with the hope that the price will come back one day, you may be in for a huge loss. A very big part of not losing money is not making irrational decisions. Remember this one thing. Investing is a game best played long term, and in order for you to get the best results, you need to make sure that you have the best players on the field, with the skill and endurance to make it to the end. This leads me to number 3. The markets can remain irrational longer than you can remain solvent. John Maynard Keynes was an early 20th century British economist, best known as the founder of Keynesian economics and the father of modern-day macroeconomics, the study of how economies, markets, and other systems that operate on a large scale behave. This quote conveys a cautionary message, a warning to investors about the unpredictable nature of financial markets. In essence, the saying suggests that even if a market appears to be behaving irrationally or contrary to what one might expect based on available information, it can continue to do so for an extended period. This irrationality can lead to unexpected outcomes and cause financial losses for those who bet against it. The phrase also implies that individuals who attempt to take positions against the market trends based on their own unfounded and unresearched beliefs might find themselves in financial distress if the market does not align with their expectations. It emphasizes the importance of recognizing the influence of market dynamics and being mindful of the potential risks associated with opposing prevailing market sentiment. Overall, it serves as a reminder to exercise caution, manage risk, And be aware that market behavior can be driven by various factors that may not align with logical reasoning or immediate expectations. Just as holding on to a good stock for a long time can bring you good returns, which put you in a good position, the opposite is also true. This point is a segue to number 4. The stock market is a device of transferring money from the impatient to the patient. Patience is a key element in investing. A lot of people go into investing with the wrong mindset. They expect to start investing today and start seeing results tomorrow. This kind of mentality causes a lot of people to make irrational decisions that lead to the loss of money. Conversely, those who go into the game of investing with a long-term approach, working strategically, tend to see good results. It is very important to understand that you don't really lose or gain money in the stock market until you decide to lock it in by selling. If you don't sell, the status of the stock will continue to fluctuate, which is not a bad thing. A lot of people get emotional when they see big movements or when they see no movement at all. As an investor, you need to exercise a lot of self-control and delay gratification in order to get the best of results. This is something that Charlie Munger talked about in a recent video I made, which you can find linked in the description. One of the best things you can do for yourself is to not just take anyone's word as to what is going on in the market. Always do your own homework so you don't end up buying or selling on impulse because of something you heard being said somewhere. Exercise patience and let the power of compound interest work its magic for you. Number 5. Buy when everyone else is selling and hold when everyone else is buying. This is not merely a catchy slogan. It is the very essence of successful investments. J. Paul Getty was an American-born British petroleum industrialist who founded the Getty Oil Company in 1942, which he owned and controlled along with nearly 200 other concerns. He was reputed as the richest man in the world at the time of his death. This statement is one that many long-term value investors will agree with. As an investor, you need to think differently from everyone else. You need to have a counter-cyclical mindset that allows you to see opportunities in the face of trouble. As the saying goes, riches are made in recessions. In order to benefit from a problem, good businesses will find a solution and monetize it. As an investor, you need to identify such type of businesses and capitalize on their growth. When the markets go down, a lot of people tend to sell off their shares. This causes share prices to drop, and by correctly identifying good businesses and buying up their stocks then, you'll have the opportunity to ride the wave up when the stock market picks up again. Buying the dip can be very lucrative if done right. Number 6. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Paul Samuelson was an American economist who was awarded the Nobel Peace Prize in Economic Sciences in 1970 for his fundamental contributions to nearly all branches of economic theory. He contributed to many areas of economic theory through powerful mathematical techniques that he employed essentially as puzzle-solving devices. In this quote, he's basically saying that investing in stocks for the long term is kind of boring. It's not like gambling and should therefore not be treated as such. For the most part, it comes with no fanfare, especially when you invest in a broad index fund like the S&P 500, which you just need to consistently add to, reinvest dividends, and just watch it grow without having to do anything else. If you want to take the simplest approach to investing, this is it. Historically, the S&P 500 has never yielded a negative result over a 20-year period. So long and slow is the way to go. Number 7. The 4 most dangerous words in investing are, "This time it's different." Sir John Templeton was regarded as a contrarian investor and mutual fund manager who founded the Templeton Growth Fund in 1954. Templeton is known for his global investments as a pioneer in both financial investment and philanthropy. He spent a lifetime encouraging open-mindedness. This quote is very straightforward. The past is to be learned from, so we can prepare for the future. We can learn a lot of lessons and identify patterns from times past in order to know how to deal with certain conditions. That being said, we cannot apply the same methods today that didn't seem to work then and expect them to work now. Insanity is doing the same thing over and over and expecting different results. Learn from your mistakes and make sure not to repeat them. Number 8. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential. Here's some good news. You don't have to be the smartest person ever for you to become a good investor. Buffett emphasizes that investing is not solely about intelligence, but rather rational decision making. Emotional biases, herd mentality, and impulsive behavior can negatively impact investment outcomes. This quote underscores the importance of being logical, disciplined, and patient when making investment decisions. Emphasizing rationality over intelligence helps investors avoid common pitfalls and make more sound investment choices. If you've ever felt that you aren't smart enough to understand how the stock market works, get rid of that belief and start learning and applying so you can start earning and multiplying. Number 9. The stock market is just a vote of confidence on what's happening in the country. If you don't believe in the country, you shouldn't be in the stock market. Peter Lynch is an American investor who managed to beat the stock market for 13 years straight as the manager of the Magellan Fund at Fidelity Investments. He's one of the greats in the world of investing. Lynch highlights the interplay between the stock market and the broader economy. The stock market is influenced by the overall economic conditions, business environment, and investor sentiment. This quote suggests that having confidence in the country or economy is important for participating in the stock market. If an investor lacks faith in the country's long-term prospects, they may not have the conviction to withstand the market volatility or make successful investment decisions. This is something Warren Buffett would agree with 100%, as he said on numerous occasions that he can never bet against America and its businesses. He believes in the country that much. Those are the 9 quotes about investing as promised. But since you stuck around until this point, I have 2 bonus quotes for you. One is from Warren Buffett, and another is from Charlie Munger, his right-hand man. Whether we're talking about stocks or socks, I like buying quality merchandise when it is marked down. All intelligent investing is value investing, acquiring more than what you are paying for. You must value the business in order to value the stock. Both of these quotes have this in common. They speak about value investing, how we should look to get more value out of what we pay for. They clearly imply that in value investing, despite the price we pay, it is the value that we get that matters the most. Investing in stocks is all about determining the price-value gap and acting accordingly. Further, each stock is nothing but a piece of underlying business of the company. Hence, to know the value of the stock, one needs to understand the value of the underlying business. So there you have it. These are only a small portion of the teachings from all these great investors. Hopefully this inspires you to seek more learning, so you can learn even more from them. What did you think of these quotes? Which one did you like? Would you like to see more videos like this? Comment below and let me know. If you found value in this video, then pay the price by hitting that like button and sharing the video with a friend. Don't forget to invest in the channel by subscribing if you haven't already done so, and clicking on the notification bell that will pay dividend every week in the form of new videos. Thanks for watching. Hope to see you in the next one. But until then, stay invested.